Hey everyone, Cotton Candy TA here. Welcome to the course on mental analysis, defining the psychology. All right, if you enjoy the content so far and haven't subscribed to the channel yet, go ahead and do so. If you want to support what I do, you can find those details in the video description. And if you haven't checked out the Twitter account, go ahead and do so as I post up my content release schedule, day-to-day activities, and different charts that I'm working on through TradingView. All right, before we start this lesson, I want to talk about a book called Trading in the Zone by Mark Douglas. Mark Douglas is probably the master of psychology and mental analysis and the training of the brain when it comes to day trading. When I first read this book, it changed me as a trader. It took me from a somewhat profitable trader to a consistently profiting trader who was able to better grasp and get a hold of his emotions, define characteristics, reduce and take away a lot of the negative, toxic, bad things that were hindering my trading. It was a large turning point in my trading, probably one of the largest. And I don't think there's anybody better than Mark Douglas to teach this, including myself. A lot of what I go through in this mental analysis course will be paraphrased from this book. Not a lot of it, some of it will be. I have my own takes on mental analysis that I discuss and things that I've discovered on my own that aren't included in this book. But Trading in the Zone has been one of the cornerstones for many traders in the space. I would highly recommend you read it. There's an audio book for it. Pick up the novel if you prefer paperback. Download PDF, whatever your preference is. Trading in the Zone, an amazing book that I would recommend, and you can see it right there on the screen. We'll zoom in a little bit here. So Trading in the Zone, Mark Douglas. Okay, I'm going to take that off now, and we are going to get into it. Okay, what's mental analysis? All right, mental analysis is the training of the mind and the brain. It is the training of the psychology. Everything in markets is people versus people, right? It's like a game of chess or a game of poker. There is no house. The market isn't the house. There is no in-between factor. It's you versus other people. So psychology always is going to play a large key role when you're talking about a game or a framework or something that's person A versus person B, result one versus result two, right? Very black and white. So mental analysis is one of our great tools in trading. There's three types of analysis. There's technical analysis, which is our charting abilities and the rules we create. So the softwares we use and the charts that we create, that's technical analysis, also known as TA. There's fundamental analysis, which is known as FA, which is the belief of companies, things like roadmaps, what they stand for, the foundation of the company. So more on a business level. And there's mental analysis, which is MA. And mental analysis is the training of the psyche and the psychology and the mind and the tuning of understanding the markets better. So TA, FA, and MA. FA, just to give you a little bit of history, is what was used to be. FA is what they used to use to trade the markets. So before the 80s, before technical analysis was kind of discovered and figured out, FA is what was traded based upon. So people would look at the fundamentals of a company, say, this company looks great because they offer something and we agree with the fundamentals of that. So they offer this type of technology and it makes sense, so we believe it. Therefore, we are trading it based on FA. So that's what was used before the 80s. Around came the 80s and technical analysis was kind of discovered and people saw that there was a better way to do things. They recognized patterns in the industry, charts, this and that. So the birth of technical analysis was also the beginning of the birth of mental analysis. And mental analysis has been around for a long time, but it was more popularized after technical analysis came out, just because it went hand in hand with understanding how to chart the technicals as well as to train the brain to further refine our skill sets. So that's what mental analysis is. Okay. Mental framework and the different triggers we all have based on genetics. So every human being is going to have different triggers based on genetics. Some people can't handle taking a loss. Some people handle it too well. Some people, it affects them so little that they actually don't let it help refine them. And some people, it's polar opposites, right? And some people, it affects them so much. Every time they lose a trade, they feel like it's the end of the world. It becomes emotional baggage. It becomes heavy weight on the psyche. It becomes this anchor in your mind that never really goes away, or continuously builds and compounds. And in between those two opposites, there's everything in between. So, the first thing about mental analysis is understanding that we all have different triggers based on genetics. So some people are going to get uh, largely affected where others are not. So kind of discovering what your triggers are, kind of that self-reflection and thinking about, okay, what bothers me, what doesn't bother me, what should bother me, and how can I improve it? These are the things you'll need to go over and discover throughout this mental analysis course. And these are the things that you want to be thinking of. What are the things that bother me, and how can I refine them to make them better? Because the whole point of mental analysis is to take whatever type of genetic you fall into, whatever type of predisposure you have, and to refine that to make it work for you and not against you. So understanding your own personal mental DNA, I guess is the best way to put it, is a huge part of defining your own psychology. Because if you can't understand your own genetic defects or mental defects or emotional defects, then you won't be able to work on the things that you refuse to see, or refuse to acknowledge, or aren't aware of, because you just simply don't look at them. Okay, market fear, how it's generated. So market fear, and this is stuff that Mark Douglas goes over in great detail in his book, so I'm not going to go into quite the depth that he does. I believe his audiobook is about 9 hours, or somewhere between 7 and 10 hours. I read the paperback, so I'm not sure, but from what I remember, I think it's about maybe 9 hours. And he does a great emphasis on market fear and how it's created, and has lots of examples. So if you want to dive deeper into market fear, go ahead, pick up his book. Regardless if you want to or not, pick up the book and read it, or the audiobook or whatever. It will change you as a trader for the better. Market fear is that it's that predisposure, or that compounding mental torture that we have in the market. It's every time you enter a trade, you have this precomposed set of thoughts that are saying, okay, well, this is going to fail, or you have anxiety. It's fear of getting into a trade. It's fear of losing money. It's the things that are compounded, and the fear that we get when we lose a trade, or when we have too much emotional baggage or too much mental stress. Market fear is very detrimental to trading. Mark Douglas goes over a great example, and I'm going to paraphrase this. It might not be exact, but it's right out of his material. A young child gets bit by a dog. The child is 3 years old. When that child gets bit by that dog, they create a psychological event in their mind. Forever, when they're 5, 6, 7, 8, they may not remember that moment that the dog bit them, but they have a fear of dogs for the rest of their lives, and they have this kind of ongoing misunderstanding of why they have a fear. They got bit by a dog. It created this big psychological impact that stayed with them for a lifetime, and they may or may not remember it, but the fact is that created a fear of dogs. It's the same thing in the markets, right? It's the same thing when we lose a trade. Every time we lose a trade, it's this compounding effect. Every time we let that emotional baggage or that stress affect us, it's this compounding effect that will constantly grow and grow and grow. It's like a pot of boiling water. You put a tablespoon of water in a pot, and it bubbles at the bottom, and you keep adding a little bit of water each time, and that bubbling effect rises to the top until it's spilling over the pot, and you're making a mess all over the stove. And that's kind of like market fear, right? That's the compounding effect of having these emotional events and psychological events that weigh on your mind, and they continuously compound. So if you don't have the tools, and you don't know how to get rid of that continuous effect, it will get to a boiling point, and you will be spilling water all over the stove and panicking. And that's the way our mind works, right? Every time we have one of these market fears, or these triggers, one of these outcomes, it compounds. So we need to be able to create a tool set to get rid of that. Okay. So fear's possible outcomes. Okay. So fear's possible outcomes are generated from pain, from doubt, from despair. They create emotional weight, mental baggage. And really the point of identifying these things, the point of identifying the pain that it gives us, right, when we enter a trade and we lose a trade, and that pain and that a constant nagging of, oh man, why did I lose another trade? Like, why me? This is so unfair, right? Which then creates doubt in going into every single trade. uh, which creates this revenge cycle, wanting to get into trades based on revenge, which we'll touch a bit on later. But it creates that doubt where you start doing perfect technicals, you mark out the perfect levels, you have perfect entry, but you start to doubt yourself, right? Then you go into despair because you've doubted yourself, you didn't enter the trade. The trade played out exactly how you thought it would based on your technicals, right? And then you go into despair because you start thinking, like, why did I get into this trade? That could have been easy 10% or whatever the amount is. So then you get into despair, and all of these things, the pain, the doubt, the despair, it all adds emotional weight and mental baggage. Every single one of them, and sometimes 2 and 3 at a time. So it quickly, if you don't know how to release that anxiety, it quickly takes over your mind, and it quickly poisons your ability to trade properly and effectively. So fear's outcomes have a great impact on your psychology and on your mind. So with that, there's the two sides of our emotional table. And again, this is part of paraphrase out of Mark Douglas's book, Some of These Things. So if you've read the book, you'll notice similarities. And if you haven't read the book and you go and read it after you've gone through this mental analysis course, you'll be able to further delve into these. But there's no way I'm going to do 7 hours of rambling about mental analysis. My take on it is almost the same as Mark Douglas's, but slightly different. Okay, revenge is the strongest emotion you will face. The two sides of the emotional table, right? Revenge and euphoria. So the two extremes of polar opposites. Revenge being the I lost, so I'm going to get you back, and euphoria being, hey, I won, so life is good. Both can be harmful. So revenge is the strongest emotion you'll face. We all have gone through it. We all do it. We see a losing trade that we're in, and we have that emotional weight or that mental baggage that we carry, and we lose a trade, and we're at a point of such despair that we start revenge trading, right? We start saying, well, I'll show you, I'll teach you, I'll make this trade here. And you start revenge trading and forgetting all the things that you build upon, all the perfect entry based on technicals, all the correct mental training and preparation that it takes to go into a trade. You start revenge trading, which generates more losses, which compounds even harder on the fear and that market fear that disembodies your ability to trade properly. So revenge trading is something we've all done, whether it be big, small, wins or losses. You can revenge trade and have bad outcomes, or you can revenge trade and have good outcomes. Both are highly detrimental. Any form of revenge trading, whether the outcome be you could have made 100% on a trade, that revenge trading is very toxic and very cancerous for your mental analysis, and it's very hard on your psyche, because it creates a repertoire. It creates a repertoire of, oh, if I lose this trade, who cares? I could just go and double down and slingshot some trade and make another 100%. So I don't care. I just revenge trade anyways, and it's all good. And that's the absolute worst thing you can do. that is like the surefire formula to liquidating your account, or to losing it all, or to having big losses. There's no quicker way to do it than revenge trading. Even if you've revenge traded nine times in a row and they've all been hugely positive, that 10th time it's gonna hurt you worse than those 9 times that got you to where you were. It'll put you on a path where you feel the need to show the market you are right, to prove yourself by making wild moves and efforts to win against it by entering revenge trades. And exactly that, those wild swing trades, you can't enter them. So euphoria is the opposite of revenge trading. When we win a trade, we do the opposite of trying to prove ourselves. We start thinking we're above training and start ignoring our own rules. So that's the thing about euphoria. There is a balance in the psychology. There is a balance in mental analysis and controlling your emotions and your mental state. There is a balance between one side being the fear, and the other side being the fear, and the other side being the euphoria, right? The fear of the market and the bad outcomes and the good outcomes. You do not want to be like a swinging pendulum back and forth between two. You also do not want to be standing against the wall. If you're a euphoria trader, that is also very harmful to the psyche. The whole point of mental analysis is to have maximum neutrality in trading. So the whole point of it is to be smack dab in the middle between the two. So you can see the pitfalls of euphoria trading and you can see the pitfalls of the fear. So all the bad things that come with fear and revenge, and all the bad things that come with winning trades, because winning trades do have negative effects too, right? So understanding that you can't always be this cool, calm, collected trader. It has to be a very analytical process. It has to be a very controlled emotional state and a very controlled mindset that you use to create the perfect mental state, right? And then reality versus expectation. This is kind of a common life lesson that everybody learns at one point or another. We always in our minds have this expectation that flies up here, and we go into a trade, or we go to get a house mortgage, or we go to want to buy a brand new car, or whatever it is, and we have this expectation. We say, okay, I want this house, or I want this car, or I want this trade to do this. So if I just do everything perfect, like, oh man, it's going to be great. You know, we're going to be flying through the sky. It's going to be fantastic. So there's always that expectation, but then reality comes in, and reality is down here, right? And they kind of meet somewhere in the middle, and typically reality comes, or expectation falls down towards reality 90% of the way, and expectation just slightly edges up a little bit. It's like when you go for a job interview and you're like, oh man, this is like the perfect job, and I love this, and I'm going to be doing all these cool things, and I'm going to be doing whatever I love to do, and I'm going to make so much money doing it. And you get to the interview process and you go through it, and you're like, yeah, it's a perfect job for me. And then all of a sudden the interviewer says, great. And it pays $16 an hour. And that's great. $16 an hour is good money for some people, and that's fine. There's nothing wrong with $16 an hour, but maybe you expected that you'd be making $30 an hour. So you have that expectation meeting reality. It's the same thing with trading. There's always the expectation when we enter a trade. There's always the expectation that it's going to do this. Oh, I'm going to make 10% on this trade because it's going to be, roo-ha-ha, and it's, I know exactly what's happening. Because let me tell you something, you never know what's going to happen. That's the mental analysis part of things. You'll never know, and expectation comes, and maybe you lost 1% instead of making 10, or maybe you made 3% instead of making 9%, right? It's that reality versus expectation. So having that reality defined is important, and having an understanding that there's a difference. Having too many expectations on the market, on yourself, on trading, having too many expectations will swing you to that side of the pendulum where you're in that euphoria zone, or you're on that side of the fence where maybe it's not quite market fear, or maybe it's not quite revenge or those bad psychological triggers, but it's the bad triggers that are created from the good parts, the good feelings, right? So expectations are flexible, but our rules must stay rigid. So what that means is, kind of a caveat on reality versus expectations. Our expectations have to be flexible. Being a trader, you have to have flexible expectations. You cannot set an expectation bar here and refuse to move it. If you set an expectation bar of 10% on X trade, or even 1%, make 0.5%, you have to be able to say 10% is not working out. I have to have the mental awareness to realize that I'm okay with taking 2% profits on this trade. And that's the flexible part of it. Your expectations will always have to be flexible. That's part of good mental training and mental analysis, and just good life advice is any expectations you have, whether it be, again, job, car, mortgage, life, even the eggs you cook in the morning. If you expect them to taste amazing, don't get mad when they taste okay because you misseason them. It's a stupid example, but it's just everything in life. You have to be flexible in your expectations. But in trading, we must stay rigid in our rules. So we will define these rules after I have kind of an idea map and kind of a chart that I've made for this, and I'll show you some of the rules that we go over. But you'll set a standard for yourself and a set of rules that you have to always follow those rules with flexible expectations. And it's very important. It's very important to have this set of rules to say, I can't get too upset at the market. That's my rule. I can't let fear consume my mind. That's my rule. So what I do instead is I alter my expectations so that those things aren't going to impact me psychologically. So if my expectation was to make 10% and a move is clearly failing, but I could make 1% now, I'm going to get out of the trade at 1% because my expectations are flexible, but my rules are rigid. And the rule being that I can't let that market fear impact my mental state. So, expectations being flexible, but rules staying rigid is a must. Okay. Now, there's another part of expectations. The expectation we put on ourselves and we think that others put on us as a pro trader. So what that means is, you tell people you day trade for a living. They have an expectation of you, and that affects your own mental state and psychology because you're telling them you're a day trader for a living. So they think you're some Wall Street hero who's making $500,000 a year and riding in boats and driving convertibles and this lifestyle, this doctor disrespect lifestyle. And that's the expectation we put on ourselves because that's the mental framework that happens. We say we're a pro trader and they have that expectation on us, and it affects our psyche because we know that that's what they expect. So we feel like we're failing when we can't show people we drive the fancy car and live in the big house and this and that. Maybe you do, maybe you don't. I don't know. It doesn't matter. Whatever side of the field you fall on, it's the idea of that expectation that we put on ourselves when they look at us, and we have to say, well, okay, mate, I just I drive a 2014 Corolla. I love it. It's great on gas, right? So whatever that expectation that other people put on us, you cannot let that affect you because being a day trader is very much controlling your mental awareness and your mental state and working based off neutrality. It's almost like if I had to compare it to something comparatively to like I don't know if it's an analyst, a data analyst, or some type of data keeper. Basically, we have a set of rules that we follow, just like a set of web code. There's a set of rules that say we can do this, this, or this. We end up doing this, which is the trade. So the set of rules says we can enter the trade at this point based on this criteria. We enter the trade and we accept one of three outcomes, and whatever outcome we accept, we catalog that in a book and we move on into the next trade. So some type of data keeper, I guess. That's almost perfect. Perfect abstract comparison, I guess. It's a little abstract. Right? We have to operate in extreme neutrality to just strip away all that expectation and just say we did this, we accomplished that, this is where we exited, move on to the next, or use that as an analytical tool. Okay. Strip away the expectations to reduce the strain, right? And that's the point. Is you strip away all these expectations that you put on yourself. And that others put on you and that you put on yourself to reduce the mental strain and to reduce the emotional baggage that it puts on you, right? It's all about reducing strain. Mental analysis is all about reducing that strain. Okay, trading is a creative process. This is very important to know. We make our own rules on charts. We can only blame ourselves when these rules fail. So what this means is this. When you are charting something, when you are drawing levels of support, when you are drawing wedges, when you're drawing peaks and valleys, whatever technicals you're using, when you're doing technical analysis, you are creating a rule set. When you first load a chart, it is blank. All it shows you is candles that do this. They go up and down and up and down and up and down and all over the place, and that's all they do, right? That's all we have is just a black chart or white, whatever color you use, green and red candles. And that's it. And what do you do as a trader? You start mapping out levels. You start drawing wedges. You start drawing trend lines. You start doing all these different things. Those are the rules you're creating. So you are creating a set of rules to say, I understand what's happening in the market. This is my rules. I expect the market to follow my rules. So trading is very creative because there are no defined sets of rules. It is a very creative process. And there's good technicals and bad technicals, and I hope that you guys veer on the side of good technicals, and when you create good technicals, they create accurate rules, but at the end you're the one who's created those rules, right? So you can only blame yourself when they fail. You can't blame the market. The whole point of this line here, this point, is that you cannot blame the market when your rule set fails. If you've drawn levels, maybe it failed because you drew the wrong levels. Maybe it failed because something happened in the market. There's a soft crash of some type. Maybe it failed because one person who had a large hedge fund just wanted to push the market down. There's any number of variables that could affect the market. And you can only blame yourself when these rules fail. You cannot blame the market. The market is never at fault. You have to realize something. The market is just a graph with candles. It's just a set of data that shows people what to do. There is no house. There is no back-end supplier who's making money off the trades. Well, there is, but those are services, right? Those are not the market. The market has no responsibility other than to show us the price of something and the history of that price. Everything else is up to the people. Everything else is psychology. Everything else is the rules that you create. So you can never blame the market, right? You always have to blame yourself. And if here's a situation, you draw the perfect levels. They're correct 100%, right? You're this awesome trader. You're this awesome technician. You took my course and you were able to draw the perfect levels, okay? So you drew the perfect levels, but you're not disciplined enough to put a stop. Move fails. You don't stop out. You lose 10% because you didn't put the right stop. You didn't lose 1%. You can't blame the market for that either. Even if the move isn't organic and it's manipulation of some type, you can only blame yourself because you forgot to implement a rule. You forgot to implement a stop loss. You forgot to implement some type of protection and safety factor. You're just freeballing a trade without a rule to protect yourself, without a protection rule. So even in that situation where it's not organic, where it is manipulation, where you've drawn the perfect levels, where everything worked out perfectly, and it was actually on paper the exact right move, if you didn't put a stop, you're still to blame, right? So it's never the market's fault. You have to realize that. Whose rule set do you follow, right? So this is something I want you guys to realize too. Just talking about rule sets. Whenever you look at a chart, okay, whenever you go on TradingView and look at someone's chart, whenever you make your own chart, whenever you look at a friend's chart, whenever you Google Bitcoin and or the S&P or whatever you're trading, US against the pound, whatever, whenever you Google those things and bring up charts, you are agreeing and actively accepting their rules, or you're declining and disagreeing with the rules created by its artist. So when you look at a chart and you say, oh, that looks good, you are agreeing with the artist's rule set. Be very aware of that. Don't look at a chart, think, oh, I'm going to follow this, without the understanding that you believe in that artist's rules. You think their rules are correct and accurate because it's creative. There is no math or exacts behind this. There are exacts, but they're technical exacts, not mental exacts. They're different, right? The whole point of this is to know that whoever you're looking at, whatever chart, whether it be your own or someone else's, you are agreeing with those rules if you are partaking in that trade, okay? So that's very important to understand. The market has zero responsibilities. People move the market, not market moving the people. And that kind of goes back to what I was saying before. Only people can move a market. Only a group of people buying a stock or selling a stock can move it up or down. The market can't move the people, right? Only the people can move the market. So again, the market has zero responsibilities to you. If something fails or a move fails for whatever reason, that's not the market's fault. And that's a point that when I realized that I was losing against other people or winning against other people, it was kind of a changing and a turning point for me, because I was able to stop saying and being angry at losing moves, because it's like a game of chess, right? You can't be mad at the other person you're playing chess against. If you're in a game of chess and you're losing and they've made better moves than you can't be angry at them and say, wow, it's your fault I lost because you made those moves that made me lose. Well, no, it doesn't work like that. If you lose a game of chess, you lose because you made the wrong moves, not because they made you make the wrong moves. Nobody can make you buy or sell a stock. You have to actively accept that responsibility in your mind, right? You have to actively say, I'm going to accept this responsibility of entering this trade. And when you enter a losing trade, or when you get out of a losing trade, you lost against someone else. You didn't lose against the market. You lost against other people, right? And the same thing when you win. You won against somebody else. You were the winner against another person, not against the market. You're not playing against the market. The market is just there to show you data from the past and current, right? So, edges on the market, such as patterns, shapes, events, levels, tests, etc., should have zero impact on your mental and emotional state. Failed moves based on historical events can have no influence. Although they can give us an advantage, they're egregious to our mental state. So what that means is that we can do all these things that are technical indications, such as a pattern repeating or a shape of some type, like a wedge, or an event like news related, or levels or tests of support, resistance, or whatever, that can have any impact on your emotional state. The technicals have to be separated from the mentals, right? The mental analysis and the technical analysis have to be two separate things. There is a playing field for things like shapes, events, levels, tests, historical events, and that's in our technicals. This is something different. This is a different tool set. This is the training of the mind and the brain. That doesn't mean that your technicals mean nothing or that they're wrong. Your technicals are going to be your bread and butter, but your mental analysis is going to be your emotional and mindset, the state of your mind in the ability to take proper trades, right? If you don't have a clean mindset, if you don't have a proper mindset, you're not going to be able to take proper trades, right? And the last thing I want to touch on before we get into this diagram down here, and this diagram we'll go over in the next video, part 2 of the mental state. I've kind of hidden it, but if I start to toggle this, I'll remove. Oh, oops! I'll remove this in the next video, and you guys will start to see the chart that come on, it's being a little funny here. Okay, let's try it this way. You'll start to see the chart that I've created, because I've kind of created a map and a chart to kind of help with the flow of this, to identify some of these things that I'm talking about here. And it's a great chart. I spent a lot of time on it. I'm going to upload it in the video in part 1 and 2. I'm going to upload it. So if you want that chart for yourself as a kind of this thing that you look at on a daily basis or whatever, it'll be very helpful to you. I spent a lot of time kind of perfecting it and making it make sense, and it's simple but very effective. So entry, target, perfection, and neutrality. This is our focus. So with the focus of mental analysis, right, the end goal, kind of the end objective, is to have perfect entry. And part of perfect entry is having a clear mind and a clear state of awareness, and saying, I'm accepting this trade. I'm going to be mentally responsible. I'm not going to let it impact me. I'm not going to let things like fear dictate my move, fear dictate my exits. I'm going to have a plan. I'm going to stick to it, and I'm going to be as neutral as possible, because really in the end of this thing, I'm going to have a trade. It's going to execute in one of X amount of ways. So I'm going to enter a trade. It's going to execute in one of 3 ways: profit, no profit, no loss, or loss, right? So I'm entering, it's going to end in one of 3 ways. I'm going to accept that. I'm going to analyze that once it's done to see where flaws are, to refine my process, and I'm going to move on to the next one. So it's almost like filling an order, right? It's almost like working at McDonald's and filling an order. I want a Big Mac with no pickles and no onions, with a large fry and a diet Sprite. Right, all you're doing is filling an order. So you have to kind of look at trading and mental analysis as that you are going through the steps to fill an order and saying, okay, this is complete. I have done my due diligence. I've stayed in a neutrality or a very neutral zone, and I can move on to the next trade with no encumbrance on my mind and no encumbrance on my trading psyche. Okay, so this has been kind of defining the psychology in a very quick manner. Again, taking 30 minutes to just talk about some of the psychological cues and triggers and effects. This stuff goes on for hours, right? You can do a lot of homework on this, and one piece of homework that I would highly recommend everybody do, because this was my turning point in trading, is that book by Mark Douglas, Trading in the Zone. It was huge for me, and it will further elaborate and go down deeper down the rabbit hole on some of these things that I've talked about. And a lot of things I've talked about, I digressed from his book. So I paraphrased it in here in ways that made sense to me, with some examples that are straight out of his book, exact out of his book. And some examples that are my intake on it, or my thought process behind it. But mental analysis is kind of this unified concept. So mental analysis is very important. Go read that book by Mark Douglas. And that's it for part one. There's going to be a part two, which will be the next part, which will go over the trading chart, and that'll be pretty eye-opening. So I hope you guys enjoyed this digression on mental analysis, defining the psychology, and we'll see you on the next one. Take care.